AAR Corporation has just released its fiscal 2026 second quarter earnings. On the surface, this looks like a quarter that beat across the board: revenue, profits, guidance, all clearly ahead of expectations. The stock reacted immediately after hours. But what really makes this report worth breaking down isn't whether it was good or not. This is a quarter that's testing whether AAR's strategic shift over the past 2 years is actually starting to work, and today we're going to walk through that story from start to finish. Hey everyone, welcome back to Deep Dive Stock Earnings. Today we're focusing on just one company, AAR Corporation, ticker AAR. Let me be very clear up front, this is not a short-term, headline-driven earnings recap, and it's not about whether EPS beat by a few cents. The real question is whether AAR's transition away from a labor-heavy, low-margin maintenance business toward a higher-margin, more scalable aerospace supply chain platform is truly gaining traction. That's the question we're going to break down in this video. Looking first at the headline numbers, AAR delivered a very strong quarter in fiscal Q2 2026. Adjusted diluted EPS came in at $1.18, well above the street's expectation of $1.06, representing roughly 31% year-over-year growth. Revenue reached $795 million, also beating consensus estimates of around $758 million, up approximately 16% year-over-year for an industry like aerospace MRO, which has traditionally been low-margin and highly cyclical. This level of growth and execution quality already stands out. But if you stop at the phrase "beat expectations," it's easy to miss the real point. What actually determines long-term value isn't whether a company beats estimates in a single quarter, but how that growth is being generated. If it's just cyclical recovery, those gains can't disappear quickly when the cycle turns. If it's driven by structural changes and operating efficiency, that's a very different story, and the distinction is exactly where this earnings report becomes interesting. That distinction shows up clearly on the margin side. Adjusted EBITDA this quarter reached $97 million, up roughly 23% year-over-year, significantly faster than revenue growth. EBITDA margin expanded from 11.4% last year to 12.1%. In a labor-intensive MRO business, this is a meaningful improvement. It tells us AAR isn't just doing more work, it's converting incremental revenue into profit more efficiently. Operating leverage is starting to show. When profit growth starts to outpace revenue growth, it usually signals a shift in the underlying business model. AAR is gradually moving away from a model that relies heavily on labor hours and fixed costs toward one that benefits more from scale, throughput, and structure. That shift becomes even clearer when you break down the business by segment. Parts supply was the standout driver this quarter. Revenue in this segment grew 29% year-over-year, with new parts distribution posting an impressive 32% organic growth rate. This isn't just a passive recovery tied to air travel demand, it reflects AAR winning exclusive, multi-year distribution contracts. Compared to heavy maintenance, parts distribution offers faster inventory turns, lower capital intensity, and higher margins. This segment is now the core pillar of AAR's strategic transition. Once distribution scales, it fundamentally reshapes a company's earnings profile. It reduces labor dependency, smooths demand cycles, and increases customer stickiness. For AAR, this isn't simply adding another revenue stream, it's repositioning the company deeper into the aerospace supply chain, which is why the market is starting to reassess its long-term role. At the same time, government services revenue grew 23% year-over-year, providing stability to the overall business. Integrated solutions saw a more modest 8% revenue increase, but profitability improved sharply, with adjusted operating income in that segment up more than 80%. This reflects both better contract mix and continued progress in digital systems and operational efficiency. Trax software deserves special attention here. It's not a side project, it's the operational backbone. Trax generates high-margin software revenue on its own, but more importantly, it improves efficiency across both distribution and maintenance. As scale increases, those efficiency gains compound, creating a structural advantage that competitors without integrated software simply don't have. This quarter also featured several highly targeted acquisitions. ADI expands AAR's presence in high-barrier electronic components distribution. HEICO Americas significantly increases heavy maintenance capacity. ART strengthens proprietary IP through PMS and STCS. These deals aren't about chasing growth, they're about completing the puzzle of a higher margin, more controlled aerospace supply chain. One detail that matters a lot, alongside the HEICO acquisition, AAR secured approximately $850 million in multi-year heavy maintenance contracts. This means that added capacity is already sold. The challenge going forward isn't demand, it's the execution. Delivering that backlog efficiently will determine whether margins continue to improve. After these acquisitions, net debt stands at about $884 million, with net leverage around 2.49x, still within management's stated target range. Financial risk remains manageable, but from here, the company's focus clearly shifts from acquisition to integration, cost control, labor optimization, and operational discipline. Management raised full-year fiscal 2026 guidance, with organic growth approaching 11% and total revenue growth nearing 17%. That's an ambitious target. It confirms confidence in the new structure, but it also raises the bar for execution. The direction has been validated. Now the market wants proof that it can be sustained. Taken together, this wasn't just a good quarter, it was a checkpoint tone that begins to confirm whether AAR's shift toward a higher quality, more scalable aerospace platform is actually working. At this point, the question isn't whether AAR chose the right strategy. The question is whether it can execute consistently as scale increases. Are you more concerned about integration risk or more optimistic about the long-term upside from this structural transformation? Let me know your thoughts in the comments. This is Deep Dive Stock Earnings. I'll see you next time.